Welcome to the session. Topic of this session is theoretical issues in aggregating project account. You are aware that there are various types of projects which are identified in an economy to have to increase the national income. And in order to identify the various projects, types of the projects, we conduct the economic analysis, and we select the best projects which contributed most to the the national income. And there are a number of the measures through which we measure the national incomes, like gross domestic product, the gross consumption, the aggregate consumption, gross domestic saving, and the industrial production or the agriculture production. So there are different types of the aggregate measures are there. And when we have the information about the contribution of the projects or the production activities, or various element of the project activities, and we aggregate them to find out the figure in the national country national in the to find out the figure of the contribution which are made by the project in the national income. So basically, in this session, we will be discussing about the various, the issues and concept of measuring these aggregate measures, like gross domestic product, the gross domestic consumption, gross domestic saving, or the industrial, the production or agricultural production. So, and how to estimate this aggregated measure of the national income. So that is our task in this session. And the major development or major objective of the development process or the development program is to increase the national income rapidly. Actually, we want to increase the growth of the national income. That is our objective. And for achieving these objectives, there are various projects which contribute in the national income. And basically, to identify this project which contribute most in the national income, we conduct the economic analysis. And for that purpose, the project with highest internal economic return, we identify, and these are the projects which contribute most to the national income. And the greatest contribution to the national income growth is made by those projects with which have the benefit cost ratio more than 1 or more than unity, or they have the positive net worth and at the opportunity cost of the capital, that is the discount rate. So they have the positive net worth, or they have the BC ratio more than 1. And there are different measures of the national incomes, like the most common measure of the national income is the gross domestic product, GDP, or the gross national product, GNP. And basically, the national plans basically define the economic objective to development in terms of basically the growth of the GDP or the growth of the GNP. So here, we can define the GDP. GDP is the value of the gross output of goods and services produced in the country, then less the value of the intermediary goods and services. So basically, GDP is the gross output of the goods and services produced in the country during the period, and then we'll minus the value of the intermediary goods and services which are used in the production process. So and GNP is basically it is the same as the GDP, except it include income earned abroad, and basically it exclude income transferred out of the country by the foreign owners. So basically, it include only the incomes which are produced, which are generated in the country. The contribution of the foreign economy or the external market, we minus from the GDP, then we get the GNP. For estimation of the gross domestic product, we have different ways, and there are three important ways actually which we use in the estimation of the in the calculation of the gross domestic product. The first approach is the expenditure approach. Here we, the value of the expenditure on the final goods and services produced plus an allowances for the home consumed production. That is basically, the value of the total expenditure on the final goods and services, and from that we minus the import, and basically this data are readily available and employed quite commonly. Like in the US also, this approach is used to aggregate the national income. So, and then another approach is the income approach. Here basically the sum of the factor income payment, including the capital consumption allowances, and for market price measure all indirect taxes and net of the subsidy, that is the income approach. So basically here whatever the payment we made to the factor of production, that when the sum of that become the national income or GDP, that is the income approach. And third approach is the value of the output. Here we some of the value added from every producing unit, that is basically called as gross value added, and that is a commonly used method. And India presently we are using this method of income estimation, where we just sum up the value added from every production unit or every enterprises, so that become a value of the output, or that become a value of the gross domestic product. And this approach is most interested to us because it links the project analysis theory with the national income and theory with the value added concept. And when we talk about the projects and the aggregating project accounts, so actually, in the plan or the program, first we identify the projects. So, projects are basically the first and concrete portion of the larger or less precisely identified program. So, actually, in the program or plan, we identify different projects. So, projects is we can say the starting point. And how we can define the project? Project is basically it is an activity on which we spend money in expectation of return. So we spend some money and we have the expectation that we will get out of that expenditure some return. So project basically is an investment activity in expectation of the return, which logically seems to lend itself to planning, financing, and to implement as a unit. So the purpose of the project is that we make expenditure, and so all the expenditure will be we will get back from the output or from the production activity of the project. So basically the project itself will learn the project activity. So that is the concept. And basically a nation or a country chooses those projects for implementation which have high priority in the national development program. So when we identify the projects, we always keep in mind the national development programs. And for the project selection, basically, there are a number of the alternative projects are there, and we basically have a thorough consideration of the alternative project in the economy as a whole and within the agriculture sector itself. So we analyze all the alternatives available with us, and keeping in view the economy as well as keeping in view the agriculture sector itself. And the formal agriculture plan is basically it's framed on the basis of the sustained and careful research and preparation. So when we prepare the agriculture plan, we have the thorough consideration, or we have the a careful research, and also we have a careful preparation of that plan. So we select that prepared plan, or we prepare that plan that assure a suitable balance between the alternative investment in the agriculture sector, and also we give the proper attention to the linkage between the growth in the agriculture sector to that in the other sector, leading to the growth in GDP. And there are various measures of the the various aggregate measures, various aggregate measure of the national income, like gross domestic product, the aggregate consumption, gross domestic saving, and then gross domestic capital formation in other measure, and then industrial production or aggregate production. These are the different, and on the aggregate measure of the national income, you can say. Now we will discuss about the aggregate consumption, which is one of the aggregate measure of the national income. And aggregate consumption is basically the aggregation of all the expenditure on current consumption of goods and services during the period, that is basically a financial year. And basically it is related to the living standards, and living standard is also correlated with the per capita consumption of the goods and services. And basically the per capita consumption we obtained by dividing the aggregate consumption by population. So when we divide the total consumption or aggregate consumption with the population, we get the per capita consumption of the goods and services. And here, in case of the aggregate consumption, another important concept is the consumption function. And basically, it is a relationship between aggregate consumption expenditure and the aggregate income of the household sector. Here, we correlate the consumption expenditure either with the national income or disposable income, and this is a very important concept when we talk about the in the aggregate consumption to understand the consumption function in the country. Gross domestic saving is another aggregate measure, and income that is not used for the the current consumption is saved. Basically, gross domestic saving is the difference between the gross domestic product and the aggregate consumption. So GDP minus the aggregate consumption is basically the gross domestic saving. And most of the consumption cannot be attributed to the the household sectors, and but saving is done by the other sector of the economy also, like the because of the part of the income generated in the production does not reach to the household. Although some part of the value addition from the production activity does not reach to the household for consumption purpose. So that is amount is saved basically. So basically, sometimes in the private sectors or public sector, they have the retained profit margin with the business units where they are generated and constitute a part of the business saving. So the saving is there with the the, the consumption level, household level, as well as the at the business unit level. The government also take away some income in the form of the taxes, which is part of the government revenue. And if the when the government generate the saving, and if they do not spend all the revenue on current goods or services, that become also the saving by the the government. So gross domestic saving is basically some of the saving done by all the sector of the economy, household sector, the business sector, even the government, they can have a saving. Then another aggregate measure is the gross domestic capital formation, GDCF. And the production process require the services of the different kinds of assets and capitals, like fixed capitals, machinery, equipments and structures of building or the land. They are basically the fixed asset. And the production process also require the working capital, like stock of the raw materials or work in process. They are basically the working capital. And capital formation is basically it is an act of replacing the worn out assets or creating new assets. So if you are using some machine and that is damaged, so we will replace that. And some we purchase the new machine, or we create the new buildings, so that become a new asset. So basically the gross domestic capital formation is consist of two part. One is the gross domestic investment, that is making good the depreciation on existing fixed assets. So basically the maintenance of the the existing fixed assets, and then also adding to the stock of the fixed assets, purchasing of the new assets, so creating of the new assets. And then we have the inventory assets, means we adding to the inventories. So in case of the gross domestic capital formation, it is basically the replacement or a new addition to the physical assets, and it is very important. It's more important than the financial assets or transfer of ownership of existing assets. So the bulk of the domestic capital formation is financed from the gross domestic savings. So that's why there is always focus on have the more saving from the household, so that saving can be generalized for creating the investment activity in agriculture or any other sector of the economy. And sometimes, or basically, GDS is not always equal to the GDCA, and if domestic saving may be loaned to the foreigners and contribute capital abroad. So in that case, the gross domestic saving will exceed the gross domestic capital formation, and universally, the foreigners may loan their saving to us, to the domestic economy for capital formation here, and in that condition, the GDCF will exceed the gross domestic saving. So if depreciation is subtracted from the GDCF, we get the net capital formation. So this is gross domestic capital formation and net capital uh, formation. If you minus the depreciation amount from the gross capital formation, we get the net capital formation, and basically it indicates the net addition to the stock of the fixed assets. And the treatment of the consumer durable is somewhat problematic. Like if we are purchasing a refrigerator for the household purpose, so spending on the basically we are spending on the current consumption, or we are investing in a physical assets. So that is the dilemma, how to treat the purchasing of the refrigerator, whether it is the current consumption or whether it is the physical asset. So basically it should be investment on the physical assets, because this service we are using from the refrigerator, it is for more than 1 year, and we consume refrigeration service, not the refrigerator itself. So that's why it is not a we can say the consumption item. It is basically the assets. So basically it's yield services over number of year, just as machine tools yield services over a number of years. And in the same refrigerator, in a research laboratory of a pharmaceutical company would have become capital formation. That is basically it is a capital formation. Then industrial production and agriculture production, these are also important concept, and basically they are also aggregates of the sector outputs, and the output of the industrial sector or the output of the agriculture production. So that is also basically aggregate output. So change in the industrial production are reported in the form of change in the index number. So basically we use the index number of the sectoral production. So index of the industrial production or index of the agriculture production. And basically it is essentially a change in the value of the output of the different industry, and which are weighted according to the specified weighing scheme to arrive at the value of the index number with reference to the base year. And in case of the index of the agricultural production, it is based on the value of the output of the various crop, and every crop has a weight as per the specified weighing scheme, and the value of index is calculated with reference to the base year. So methodology is basically finalized by the Directorate of Economics and Statistics, Ministry of Agriculture and Farmers Welfare, Government of India, and the index of production for few groups of crops can also be calculated, like the cereal production, the pulses production, the food grain production, oilseed production, fruit and vegetable production. So there are different groups can be made from the crops of the similar nature, and we can have the index of production index for each group. So, and the calculating of this index is very critical to the country's economy. And now we'll move to the concept of value added in calculating the gross domestic product, and which actually we are following presently. And national income is basically, is the sum of the value added of all the productive enterprises, including the development of projects. So, value added of any project basically is the market price of the goods and services completed completed less the cost of materials and service purchased from the others. So when there is a production activities there, and we calculate that value of the that production or service, value of the services and at the market price, and when we minus the cost of the materials or services we purchase from the market, that we get the value added of any project. So it is basically a difference between the gross output and the value of the intermediaries consumption which are used for the production activities. So value added may be the gross or it may be the net value added or gross value added. Both the concepts are there. And gross value added basically, it includes payment for taxes, income, the interest rate, the rent, the profit reserved for the depreciations and compensation to management and other employees, and including the social security. So all these such type of payment is also included in the gross value added. But in case of the net value added, we exclude the depreciation. So we minus the depreciation part, and we are interested basically in the gross value added because it is the gross value added by all the productive enterprises in the economy which add up to the gross domestic production. So here we can understand the concept of the value added, like in the project we are purchasing, we are taking some external input, and in the production process we add some value, and then we have some output. So here in yellow color it is the value added, the value addition or increasing the value or increasing the production due to that project activity is basically the value added from the project. So it is basically a difference between the worth of the external inputs and worth of the final output is the basically value added. That is shown as the part of the output arrow here, and this is created through the use of its own internal resources. So internal resources may be divided into two major classes like labor and capital. So so we can say we purchase some input from the market, and then we add our labor or skills, and we add our capital in the production activity. So when we minus the external the resources which we are using, then the difference between basically that is the basic result of our labor and capital. So total output is made up to the contribution from the external inputs like fertilizer and pesticides and the project's own internal input of the labor and capital. So the value added is that amount of the total output stream that is attributed to the contribution of the internal inputs like labor and capital. So here there are two different concepts now in the value added. So far we are discussing the real resource flow, that is the physical units. But when we convert this physical resources in the money system or monetary value, so it become a basically money stream. So the money paid for each of the real goods and services or their value stated in at shadow prices. So when we convert this the value in terms of monetary by using the shadow prices, so then that time we get the money stream. So money is received from the customer in terms we pay the suppliers for external input. So we get the money from the customers, and that we use to pay the supplier of the external inputs, and then the leftover money is available to remunerate the internal resources like in capital and labor. And so that become a remuneration to labor and the capital in the projects. So value added is basically is equal to the total of the remuneration to the internal factor of production. And so value added amount is the basically difference between the value of the goods and services provided by the outside supplier and the value of the output supplied by the project to the customer, plus the value of the unsold output including the home consumed production. And how to treat the labor payment, that is also important concept in the concept of value addition. So labor payment basically it include all kind of remuneration for all kind of the labors, like wages, salaries, bonus, and in kind payment, and the manager's salary, the consultation fee, and the social security contribution. All this basically a part of the into labor payment. And in case of the farmers who own their own farms and supply most of the both the labor and managerial skills, we attribute to the farmer only the equivalent of his wages as a labor, nothing at all for his management skills. So here we calculate the labor of that farmers as his money, his wages. And so anything over the wage is considered return to the capital. And since we value labor at its going wages or its marginal value product, that is basically a set of prices, it receives the same remuneration per unit regardless of which project alternative it is employed for. Then basically we have objective to maximize the contribution to the national income. So the residual which is left is basically the incremental benefit from the project activity. So generally we measure that, we call them as a cash flow from the project. So here we choose the project alternative which maximizes the cash flow related to the capital resources used, and that is at the same time maximize the value added, and in turn maximizing the contribution of the capital to the national income. And here important concept of the value addition and value added concept is there are 3-4 major terms we generally use, like value of the output of a firm. So it is basically a sales plus home consumption plus change in the stock. So there are 3 components is included in the value of the output. Then value added is basically value of the output, which includes the sales, home consumption, and change in the stock. And so the value of the output minus the cost of input purchase is basically a value added. And net value added at market price basically is the gross value added at market price minus the consumption of the fixed capital. So consumption of fixed capital means the depreciation. So we minus the depreciation to get the net value added. And net value added at factor cost is basically the net value added at the market prices minus the net indirect cost. So basically net indirect cost means the indirect tax says minus the subsidy. So net value added at factor cost is basically a total factor income, and net indirect tax is basically indirect tax minus subsidy. Now we can sum up the session that various types of projects are undertaken to achieve the goal of the national development. Economic analysis of such project is important to prioritize them based on aggregating the social cost benefit of various projects. So we have learned to deal with the aggregating project accounts, and actually how to do aggregation of the project accounts, and how to get the contribution from the national income from the project activity. So there are different measures are there, and we have discussed the concept of value added in this detail, and in basically aggregating to the project accounts and basically for measuring the national income. Thank you very much.